You know, when most of us hear the word accounting, we think it's all about math, right? Just crunching numbers. But what if I told you it's actually a language? Yeah, a language that tells the true story of any business. And like any language, it has its own grammar, its own set of rules that everyone has to follow.
To see why this matters, just imagine this. You hand your company's financial records to 5 different accountants, and they all come back with 5 totally different profit numbers. How is that even possible? It would be pure chaos. The numbers would be meaningless, and you'd have no real clue how your business was actually doing.
And that exact potential for chaos is why we need a system. To make any sense of it all, everyone in the business world has to be on the same page, speaking the same language and playing by the same set of rules.
Well, that shared language has a name, Generally Accepted Accounting Principles, or GAAP for short. Just think of it as the common grammar for the language of business. It's the framework that makes sure financial statements are consistent and comparable no matter who's putting them together.
So here's our game plan for this explainer. We're going to start with that chaos problem. Then we'll get into the foundational assumptions, the real bedrock of accounting. After that, we'll see why timing is so crucial, how accountants keep things real, and finally, we'll look at the great balancing act that pulls it all together.
All right, first up, let's dig just a little deeper into this chaos problem. It's really the best way to understand why these rules are so absolutely essential. Okay, so we get the problem. Now let's talk about the solution, starting with the foundational assumptions. These are the 3 core ideas that pretty much everything else in accounting is built on.
First up is the entity concept, and this one is a biggie. It basically says a business is its own person, legally and financially separate from its owner. The company's money is the company's money, it is not the owner's personal piggy bag.
And here's where it gets practical. Let's say you're the owner, and you use cash from the business to pay for your son's school fees. Is that a business expense? Nope. The books will show it as a withdrawal of your investment, what's often called drawings, because the business person is totally separate from you, the owner person. Next, we have the money measurement concept. The rule here is actually pretty simple. If you can't put a specific price tag on something, whether it's in dollars, yen, or pesos, it doesn't get recorded in the official books, period.
Now this leads to some pretty interesting situations. For example, your team could be the most creative, most brilliant team in the world, and that's incredibly valuable, right? But because you can't put an objective, verifiable price tag on their talent, it doesn't show up as an asset. Only things you can measure in money make the cut.
And our third core idea is the going concern concept. This is really an assumption of optimism. Accountants prepare all the financial statements with the belief that the business is going to keep its doors open, that it isn't about to shut down and sell everything off tomorrow. And here's why that really matters. When you buy a machine for your factory, you record it at the price you paid for it. You don't record it at its lower, immediate resale price. Why? Because the assumption is you're going to use that machine for years to make products and generate revenue. Its value is in its future use, not in a quick sale.
Okay, so we've got our foundational ideas locked in. Now let's build on that and talk about one of the most critical parts of accounting, when you actually record things. It's all about timing.
So there are really 2 ways to look at timing. The super simple way is the cash basis. You count money when it comes in or when it goes out. But most businesses use the accrual basis. This gives a much truer picture of a company's health by recording things when they happen, not just when cash changes hands.
So the official rule is called the accrual concept, and it says you recognize revenue the moment you've actually earned it, like when you deliver a product, and you recognize an expense the moment you've incurred it, even if the cash hasn't moved yet.
Let's use an example to make this super clear. Say you sell $60,000 worth of goods. Your customer pays you $50,000 up front and promises to pay the other $10,000 next month. Under accrual accounting, how much revenue do you record for this period? Not $50,000, you record the full $60,000 because that's the amount you actually earned.
Now, the natural partner to the accrual concept is the matching concept. It just makes sense, right? To get a real picture of your profit, you have to match the expenses you paid with the revenue that those expenses helped you earn, and you have to do it in the very same time period.
So we know what to record and when to record it, but how do we decide what something is worth? Well, this brings us to the principles that keep accounting grounded and objective, the reality check rules.
The cost concept says that an asset is recorded on the books at its original purchase price. That's it. Why? Because that number is objective. It's a fact. It's on a receipt somewhere.
The market value of that asset might go up and down like a yo-yo, but its historical cost as a solid, verifiable number.
This quote just perfectly sums up the principle of conservatism. It's a rule of prudence, really. Accountants are trained to be cautious. If there's a potential loss on the horizon, they account for it now. But if there's a potential profit that hasn't been earned yet, they ignore it until it's a sure thing. Better safe than sorry.
And now, for our final section, we're going to look at the single most elegant and powerful concept in all of accounting. This is the one that makes sure the entire system stays in perfect, beautiful balance.
This is the dual aspect concept. It's the heart of what's called double entry bookkeeping. Every single transaction has two equal and opposite effects. So, for example, you buy a new machine for $50,000 in cash. One of your assets, machinery, goes up by $50,000. At the exact same time, another asset, cash, goes down by $50,000. It stays perfectly balanced.
And this whole dual aspect idea brings us to the single most important equation in business. Assets equals liabilities plus equity. It means everything a company owns has to equal the claims against those things by either lenders or the owners. This equation it must always be in balance. It's the golden rule.
So, you see, accounting isn't just about math. It's a language, and it's built on a really logical grammar. Once you understand these rules, you can read the story of any business. You can understand its health, its past, and where it might be going. So the real question is, now that you know the grammar, what stories are you ready to go out and uncover?